Hello everyone and welcome to our investment update. I'm Adrian, founder and chartered financial planner at Sylvan Financial Management, and I'm joined today by Ed Painter, chartered financial planner and fellow founder. Hello Ed.
Afternoon everyone.
Okay, so this session is designed to provide you with an overview on the due diligence we conduct on the investment solutions. You'll hear about how two of our investment managers we work with are navigating current market conditions. But before we hear from today's speakers, I'd just like to take a moment to provide you with an update and a little background on Sylvan Financial Management. So for those of you who don't know, Ed, Jane and I set up Sylvan during lockdown in January 2021 with the shared vision of delivering an exceptional and truly independent financial planning service. Our approach goes simply beyond managing investments. We aim to empower you by providing you with the financial expertise you need to make informed decisions and to achieve your goals with confidence. We've grown to manage the finances of 165 households with over 120 million in assets under management, and we're supported by 5 staff who help to ensure the responsiveness and delivery of our advice. We're committed to remaining independent and also to being here to support you for the foreseeable future, and we want to thank you for your continued support during what can only be described as a turbulent time for the economy and investment markets in general. If you've got any questions regarding your financial plans following today's session, or if you know of anyone that might benefit from our service, then please don't hesitate to get in touch with your Sylvan contact. So let's take a look at the agenda for today's webinar, which we're going to bring up on the screen. Yeah. So Ed's going to begin by providing you with an insight into Sylvan's investment due diligence process, and he'll be followed by Lothar Mentel, Chief Investment Officer of Tatton Investment Management. And last but not least, we'll hear from Ben Palmer, Lead Portfolio Manager of LGT Wealth Sustainable Investment Service. And finally, Ed and I will answer some of the questions that you've emailed into us. But if you have any further queries, then please do let us know. Thanks again for joining us today, and over to you, Ed.
Thank you. Right, afternoon, everyone. As Adrian just mentioned, I'm going to just give you a brief overview of how we undertake investment due diligence here at Sylvan Financial Management for our centralised investment process. Just a little bit of background about us. I know Adrian's just updated you slightly there, but a few of you might have seen this slide before. We've updated it to reflect the fact we're all now 1 year older. So between the 3 directors, we've got 52 years of financial planning experience. And since we launched Sylvan Financial Management, we've seen significant market events, including pandemic, inflation, war, and bank collapses. So all very positive. But what we're trying to show there is that we've been through a number of different market cycles. We have relevant qualifications, including degrees in economics, accounting and finance, and we also have specialist qualifications in investment management. First and foremost, though, we are financial planners, and our job is to give our clients confidence in their financial futures. And through that will probably come investment management. And that's where the providers, the discretionary fund managers that provide the model portfolio services that we use, such as Tatton and LGT, come in. So our central investment process is the use of discretionary fund management. We believe that discretionary fund management offers the opportunity for client portfolios to be managed nimbly and actively, taking into account of market conditions. So essentially, that means that changes can be made to client portfolios without having to go back to clients every time. We believe that the implementation of discretionary fund management is best done through model portfolio service solutions, which effectively are a low-cost version of discretionary fund management. We have a structured due diligence process when we're looking at which strategies we're going to use, and it's broken down into 5 stages that you can hopefully see on the screen. So stage 1, we have quantitative filters. Stage 2, performance analysis. Stage 3, qualitative analysis. Stage 4, implementation. And then stage 5 is the review. So if we start off with quantitative filters, the world of discretionary fund management is very large. There's a lot of discretionary fund managers out there, and providers of these model portfolio services, there's over 100. So we're looking at all of those for clients being independent financial advisors. And we're really trying to achieve a good level of risk-adjusted return for all of our clients. That's fundamentally what we're trying to do. So the starting point, how do we get down from that 100 plus to a core group that we use? Well, we start off with these quantitative filters. So they're all on screen there. I don't intend to run through them all, but I would like to just pick on two, particularly being investment process and charges. With regards to investment process, what we're really looking at here is, what investment process are these discretionary fund managers using? Are they doing what we do, which is looking at the whole of the market for clients and looking at all of the investment opportunities that are out there? Or are they just using their own in-house funds? And that's a bit of a red flag to us. If they're only using in-house funds, they won't get through this quantitative filter. With regards to charges, over time, charges can have a significant compounding effect on returns. So we like to try and keep charges low where possible, reflecting, of course, the fact that there's a difference between price and value ultimately. But what we do is we cap the amount that we believe is appropriate to pay to a discretionary fund manager to 0.25% per year, and a number of them actually charge less than that. So once we've got through the first stage, that leaves us with a group of discretionary fund managers that we then undertake significant performance analysis on. So this is where we get the nice graphs. We've got access to a leading data source, which provides the data on all of the solutions that we use for clients and those other ones that are out there. And we look at the risk-adjusted returns of those solutions against each other. Ultimately, that's what we're doing. So looking at the two charts there, the line chart, the multicolored line chart, that actually is a selection of model portfolio services for the same risk band. So you can see there's a really wide divergence in returns. Our job is to understand what is it that's caused that divergence. Are the people at the top being sustainable and repeatable in terms of their strategy, or is it a single binary bet? And we're really looking to understand that in more detail. There will always be times when solutions that we use maybe not the best performer in the market, because you can't pick the best every single time. But we're looking to make sure that the clients obtain a good level of risk-adjusted return over the long run with a sustainable and repeatable process. The scatter chart is a bit more detailed, but effectively that shows the whole of our MPS solutions that have got through that first level of filtering, plotted with regards to performance and volatility. Now, volatility is just one risk. It's the ups and downs of investments as we hold them. And ultimately, the more volatility somebody is willing to be exposed to, historically, the greater level of return that's been achieved. So you can view volatility as the cost of trying to obtain investment returns above cash, which isn't volatile. We do this analysis to check that the portfolios are not taking excessive volatility to achieve a given level of return, because ultimately clients have to be comfortable with the level of volatility that's being experienced in their portfolios. So moving on to the qualitative analysis, effectively what we're doing here is we're getting to know the discretionary fund managers that we use. This involves face-to-face and video meetings, really getting to grips with the business, how it's structured, the key individuals, and once again, and I keep repeating myself, but ensuring that they have a sustainable and repeatable investment process, and they're not chopping and changing their underlying philosophy regularly. What we're really keen to do is make sure we have a detailed understanding of the investment process and the company structure. And that's to understand, is there one person that's responsible for what's going on, or is there a team of individuals behind them? And if that one person leaves, what happens to our clients ultimately? So we do a lot of work and due diligence on the companies themselves. So how do we implement model portfolio services for clients? Well, this is our internal matrix. On the left-hand side, we've got our 5 risk levels. Anyone that's a client already will sit within one of those risk levels. And then we've got the 2 buckets for the MPS selection. That is standard or whole of market MPS. Or then we've got the ethical or the ESG portfolios. Ethical investing is very important to a lot of our clients and is a large part of what we do. It accounts for approximately 30% of client portfolios at the current time. As you can see, for every risk level, we have 2 different model portfolio services that we'll use. They will be of the various providers that have got through all of those filterings. And really, again, we're looking for good levels of risk-adjusted return over time. We'll incorporate 2 portfolios where we believe it's appropriate from either a risk mitigation point of view or where clients have sufficient assets to make that appropriate. And probably one of the most important parts of what we do is our ongoing review and analysis of these strategies. On a quarterly basis, we run detailed performance analysis of the strategies we're using against each other and a benchmark run by a company called ARC. So a few of you may have heard of this benchmark, but effectively this is real performance data from discretionary fund managers for given levels of risk. So we can analyse the portfolios against their peers and make sure we understand what's happening and that they're performing in line with expectations. We then do an annual comprehensive market review, taking into account those 5 steps of the due diligence process. And if anything needs to be changed, we will undertake it either at the annual review or indeed at the quarterly review as appropriate. Should we need to make a change because of the way that we structure client portfolios, being held on what's known as an investment platform, it's very simple and easy to do once we've discussed the rationale with clients, and it can all be achieved very straightforwardly through the technology. That's a very quick run through of how we do our due diligence. I hope it was of interest. If you've got any further questions about our investment process, please don't hesitate to give us a call or send us an email.
That's great. Thanks, Ed. So now we'll be hearing from Lothar Mentel, and he's Chief Investment Officer at Tatton Investment Management. Over to you, Lothar.
Thank you. Thank you very much for the introduction, the kind introduction, and also for already covering quite a few things that I will refer to in my presentation. That makes it easier. I won't have to talk about quite as much or explain some of the slides that you will see. So I hope you can see the presentation now. I take it you can. So we are still at the moment what we call on a narrow path to a soft landing. As we all know, or probably have read in the media, there's a lot of talk about recession, and you could say it's the best signposted recession that has not happened yet. And so that is keeping the markets on their toes and quite volatile to a good degree. But essentially, it all boils down, and I like to work with just little pictures or cartoons, if you like. It all boils down to the central banks here, depicted by the US chair, Jay Powell, squeezing us all with higher rates in order to get inflation out of the system. And while Jay Powell in the US has just hit the pause button last week, the Bank of England today certainly did the opposite and raised rates not just by 0.25, but by 0.5%. So we're now at 5% interest rates, a level that we have not seen in more than a decade. And that's going to eventually leave its mark on the economy. But the jury is still out whether this will really lead into a deep and perhaps protected recession and therefore market downturn, or whether we will carry on in this late cycle environment where we get through it all with a dip. So in order to get to the bottom of that, let's look at what this has meant and might mean for a globally diversified investment portfolio, as you would hold, as just described by our partners at Sylvan. I always like to start with the sort of long-term view of markets, and what you can see here on this chart is the markets going back in the UK to 1987. So it's a very long-term chart, which also puts some of the previous market downturns, but also rallies into perspective. You've got in blue the UK equities, in green UK gilts. The orange line is property, then gold, inflation, and cash deposits. As we can see, over the longer term, cash deposits have been least likely to provide a consistent longer term return. Interestingly, gilts until recently seem to be pretty much on a par almost with UK equities. Now that has changed materially, as we can see there in this drop off of yields since, or of returns since last year. And that indeed is what's currently or has driven markets Because while this chart for the UK may look as if COVID is now well beyond us and the markets are off onto their usual trajectory of making gains for investors, that is a bit of a, well, it's not quite the whole picture. The UK first lagged other markets in the post-COVID recovery period, and then last year's energy prices and commodity prices shot through the roof. The UK market all of a sudden did very well, so it's been a bit of an outlier across the Western world. Because if we look at the global equities more broadly, we can see that after that very nice uptrend following the market depths, or the very trophy point in 2020, March 2020, markets have pretty much gone sideways since, which is well, that's to a certain part reflected in portfolios. But the interesting thing to note here is that this market development has not been on the back of falling corporate earnings or profits, if you like. It has been on a re-rating of equity valuations, because not just interest rates have risen, but in their wake, bond yields have risen quite significantly as well after a prolonged period of very low interest rates. So what we can see here is the longer term 10-year yields for different regions: yellow the US, blue the UK, orange Europe or the EU, and then in green Japan, which is and has been for the last 30 years. Or been on a slightly different trajectory. But what we can see is that after a long time, yields have all of a sudden jolted back to where they historically were, and you can probably well remember them to be sort of between 4% and 5%, heading towards 5%. So what we've seen last year, and that sidewards movement, that initial sell-off and then sidewards movement, is really a re-rating of equity valuations as a result of those surging bond yields over a very short time period. And that short time period can sometimes lead us to perhaps lose the perspective of the very longer term, which is why we invest in longer term investment portfolios, and why they're always prescribed as having to be held for at least 5 years in order to get the benefits through. Because if we look at this, yes, it may have gone slightly sideways last year, over the last 1.5 years, but the longer term trend here in a logarithmic chart, I'm sorry, has not actually changed at all. So if we now turn to what investment portfolios have done over the last 12 months, well, it reflects, I suppose, the sideways and up and down that we've had over the last 12 months, but it also shows how they have generated positive returns over the last 12 months, particularly on the equity side, which on the longer term is to be expected. In the shorter term, it doesn't always come through like that, but it very clearly shows right now that with the poor performance, or relatively poor performance, that we can see from the bond-heavy defensive portfolio, we can see that equities quite clearly have once again proven to be the best asset class to weather a period with elevated inflation. If we take a look at the slightly longer term, so over the period of COVID, we can see that actually the returns, apart from that lowest end bond portfolio, so anything that holds a decent amount of equity exposure, has actually generated a fairly decent return, even if at the moment inflation is nibbling away at that. But as we will discuss further, the high inflation that we have experienced over the last 12 months is not expected to last, and indeed is almost everywhere, perhaps except for the UK, coming down very steeply. And even in the UK, it's coming down, but not quite so broadly. So that's quite typical for inflationary periods. But what's also very important for us is how do we do over the longer term with our portfolios against our peers. And So here's our 10-year track record. So that's quite long term. And we already heard those ARC peer group returns mentioned. That's that black line down there. So this is a chart that shows you the returns of the different risk profiles against their annualized return figure. So it's what we call a risk return chart, and therefore gives you the quality of returns. And we're very happy to have been able to achieve higher quality returns, i.e. more return per unit of risk than the peer group average, which is really what I'm passionate about. Looking at it in a more of a table, we have here all our different portfolios mapped over different time periods against those ARC indices, ARC peer groups, and I'm very happy that we can report that we are, at least currently, outperforming over almost every time period. It is not likely to always look like that because with the steady investment approach that we have, there will be months or quarters or maybe even half years where sometimes that steady approach is not necessarily producing the very highest returns possible in the market, but that is what defines the steady return environment. So we're not betting with clients' money on any one outcome, because that, in our experience, is not in the interest of the clients and long-term returns. It just makes perhaps an investment manager famous in our industry for a year, only for them to then come down hard the following year. So, for example, in the aftermath of the pandemic, particularly technology shares in the US rallied massively. You will remember Tesla going up multifold, and those portfolios which held it looked extremely good. In the aftermath, it all came down again, and therefore, as you can see, it over the longer term doesn't really leave a trace that back then we avoided to be overly invested in those areas. But moving on then, as I said, let's see how we got here. And for that, I always like to go back and look at what we said in these sort of presentations a year ago. And we said last year that these were the variables that we would have to watch and align our management of portfolios around. So the price of oil and price of gas was really the driver between the primary effects of inflation, i.e. the goods price inflation that started this whole inflationary round. But then there are secondary inflation effects which make inflation more persistent and embedded in the thinking of economic subjects, and that's the labor markets being particularly tight, because that then really translates into that wage price spiral that central banks are so keen, and societies as a whole very keen to avoid. Against that, consumer and business resilience or weakness is what drives economic behavior, but also investor behavior, which is also driven by the direction of corporate earnings and profits, i.e. when they plunge, that usually also means that stock market valuations do go down. And if we are in the right sort of environment, then the counterbalance of the bonds in the portfolios rise and give us some diversification benefits. And then after all, there are the wild cards, as we very much found out again last year with Russia's invasion of Ukraine, which pushed up energy prices so much that it became a real economic and cost of living crisis problem. So if we look at all those variables together, let's go through them, how they've developed over time. As we can see here, the energy prices really did become a problem over last year. They spiked up obviously significantly with the invasion of Ukraine, but they had already come up early on. So the decline that we've seen this year, which has been quite important for businesses in those primary inflation effects, has come down significantly, recently bumped up a little bit, but that was more on some long planned closures of gas fields for the benefit of long-term sustainability of CO2 strategies. So probably not something we need to get overly concerned about at the moment, particularly because the problem in Europe seems to have been brought under more control with this chart showing the level to which the gas storage across Europe are filled, and that was the big concern last year, where we could see that in that blue line and then the green line last year, we were bumping along at the bottom, and there was a big concern that we would see lights and heating being turned off. At the moment, we're at very high levels, and Europe has put back into place many more gas storage reserves that had been decommissioned in the years before. So if that's energy becoming less of an issue, and we've probably all so far noticed that at the petrol filling stations, unfortunately not yet too much in our utility bills, which are always coming through with a lag. The next one is wage growth, those secondary inflationary effects. And this chart shows us a good picture for the global development, which means that the labor markets are easing, i.e. they're not quite so tight anymore as they were post-pandemic, when a lot of people had second thoughts about returning to the workplace. But unfortunately, the UK seems to be an outlier there at the moment. The reasons behind that are widely discussed, but it is probably a combination of the NHS still being quite stressed, and therefore a larger number than usual of the workforce being forced to not go to work, either because they have to care for dependents or because they're still fighting with long COVID symptoms. And the other reason is very likely that the cracking down on immigration, particularly of qualified people, qualified labor, has tightened the labor market in the UK more than elsewhere. But the portfolios that you hold are only to a smaller part invested in the UK. The bulk is invested globally, and hence why we tend to look at the global picture more than the UK picture, although I do obviously appreciate that for everybody who's on this call, it is interesting to know what's happening in the world. So if we then move on to how has that reflected itself in the sentiment of consumers, and for that matter also investors, I appreciate this is a slightly unwieldy chart, but I think overall it gives passes the message on where consumer confidence is. So the zero line there is sort of a neutral. The positive hikes up are when consumers feeling particularly bullish about the future, which was obviously the case after the pandemic. But as we can see on that chart, they really hit rock bottom just during the pandemic. And then last year, with the looming cost of living crisis, they once again really hit rock bottom and have since then rebounded. So it's not as if we're lingering at those low levels. They have gone up again across different regions, the US, Japan, the Eurozone, and UK, which are the major global markets that we're looking at. What's also then important to note is that those things that made prices of goods go up significantly are coming down now. So we call that the global producer price inflation. So those inputs that businesses have to cope with in their production process, they went sky high last year. And as we can see, they're coming back down to more normal and average levels, which has also had an impact on the wider sentiment of businesses. So what we have got here behind this acronym of PMIs is Purchasing Manager Indices, or what that is surveys that ask businesses to tell how they're feeling about the near future. Why is that important? Well, it has been found that these levels are very closely correlated with what we're seeing then in the present around the growth, economic growth, GDP in those economies. And usually they tend to move in tandem. So we can see that after the pandemic, we had a very strong rise both in manufacturing and in services. Although recently manufacturing is lingering below what would be regarded as the contraction line, whereas services are still going up. So in a sense, we could understand this as still some post-COVID cyclicality where first during COVID and just thereafter, everybody was very keen on spending their money on goods, but not so keen on going traveling or to the theater or restaurants or whatever else, whereas that's now changed and businesses may have overstocked their inventories, so they're not ordering so much anymore, which has led to now the cyclicality as demand has morphed or has moved towards services, that there's too much stock of bicycles, e-bikes, and all sorts of other things that we wanted to buy, and that's causing a slowdown in manufacturing, whereas our bigger interest now again in traveling and doing all those things that we like to do to create moments and memories is still very much in demand, and that's what's currently also particularly pressing up inflation in the UK. If we dig down deeper into the inflation numbers, it is that service sector that is really pressing up prices in the UK. Now, how has that reflected itself in corporate profits? As I said, that's the other thing that we watch. And this, again, is perhaps a chart that needs a little bit of explanation. So it goes back 20 years. And that green line that you see there is simply how corporate earnings in aggregate around the world have developed over that time period. And we can see how they really fell very significantly back in 2008, 2009, when we had the global financial and global economic crisis, and then have steadily risen since. The red line and the yellow line are actually exactly the same thing, just multiplied with a different multiplier, because what we know with market variations is that stock market levels are usually trading somewhere around a multiple of these corporate profit levels. So that long-term average there is 14.4. And as we can see recently, the stock market valuation, which is the blue line, has just simply fallen from 18 times to 14 times without actually the earnings having fallen commensurately or proportionally to what the markets have fallen by. And this is the evidence or underlines what I said early on. So far, the revaluation of markets and that sideways movement that we have seen has been predominantly driven by that re-rating of equities on the higher yields, not from earnings. Now, in terms of investor sentiment and credit, the other thing that we are looking at very closely is whether credit conditions might get to a point where we get a credit default cycle, because that tends to trigger just as much a recession as a very significant sudden drop-off in demand can do. And even though this chart may be something counterintuitive, the red is good, the green is bad in this instance, and it is very much the same as what mortgage holders in the UK are currently experiencing, which is that when they remortgaged over the last decade, usually the rates got lower and lower and lower, which is what that red area there indicates under my graph. Whereas recently they have experienced that the interest rates that they have to pay on their loans have gotten higher and higher. And that is exactly what happens to businesses as well. They also have rolling loan facilities with banks, and when they have to renew them, they now have to pay a lot more for the capital that they require in order to produce, and that is obviously pressuring and increasing default pressure also on businesses, although up to now we haven't seen particularly much of that. I said wild cards there as well, and that is China. China has reopened, and there were great hopes that it would go through a similar euphoric recovery process as we had elsewhere in the G7 countries, but that hasn't quite happened, although we are recently seeing a quite nice increase in the early indicators of economic activity. It just globally, it's been a bit disappointing for exporters to China, because China's recovery was very much focused on the service sector, not on production, on construction, on buying things from European countries, for example, in terms of cars or machinery. So it's been positive, but not quite as positive as had been expected. Now, We did, in the meantime, also have a bit of a banking crisis that you will remember, which was a big concern, but has now calmed down a lot. I think you probably haven't read or seen much about it recently, and that is probably because this banking crisis was very different to what we all dreaded might be coming back with our 2008-2009 experience, in that this time it wasn't bad credits that weighed down banks, but it was exactly what had happened to bond investors in portfolios, as I showed early on, i.e. banks, their safest assets are required to be government bonds, but if the yields on those government bonds rise very quickly, very suddenly, then because of the negative correlation between yields and the value of the bonds, the value of the bond falls, and that led to some banks in the US coming under stress. But because that is immediately, if you like, caused and the result of central bank action, it was perhaps not unsurprising that central banks stepped in very quickly in order to reassure the public that this was not going to be breaking the neck of at least the smaller banks in the US. Whether there's still a bit more to come or not, we're not so certain, but that is why that issue has gone away relatively quickly. Or if you want to, again, look at it more in terms of a little cartoon here from Cal of The Economist. So the Fed, the central banks have been very good in fighting that monster inflation very vigorously, might have overlooked what it does to certain banks, hence that a slightly frazzled banker there in the last panel of that cartoon. Now, if therefore not so much has changed, why have we then had so much volatility? Well, what we have seen is that the pressure and focus points of last year still remain. We have made some progress on it. We haven't really seen a rise in corporate earnings since, so markets have been willing to look forward and assume that we will get that soft landing without a recession, and the longer that recession doesn't arrive, the higher the likelihood probably is that that is the case. But in the meantime, whenever there's any news or any inclination or anything that might suggest that a recession is still going to happen, then this is what they suffer. So on a narrow path to a soft landing still, these are the positives that we've had over the first quarter this year. So we've come through the winter quite well, and I covered those points, but there have also been the negative points, i.e. how much is lying ahead and how much more collateral damage will there be from further rate rises until we have got inflation under control. And so that has left yields higher than they've been for a while, but not really gone beyond where they were historically. Or looking at it in a different way, we can see here the different forms of debt and what their long-term ranges in green were. Diamonds show where we are at the moment, and the purple or blue bar there shows the 25-year average, although that was a little bit depressed by the last 10 years. So we can see nothing out of the ordinary. Also nothing out of the ordinary in terms of valuations for equities. So they have now normalized to these higher bond yields, to that not being the only show in town anymore. And therefore, at the moment, everything boils down to whether we can stay on this path to a, well, we call it the immaculate disinflation process, i.e. disinflation, killing inflation without killing the economy. And historically, what we've seen is that that does indeed happen. This is what that blue field there shows. So the middle is historically when inflation peaked, and then how markets developed afterwards, after that inflation peak. And as we can see, on average, markets have improved afterwards, although there was also the 1970s where that was not the case. At the moment, we are on that red line, which is clearly not the 1970s trajectory, but we can't be absolutely certain about that at the moment because interest rates continue to be high. So this is what the markets are pricing in terms of interest rates for the period until early next year. So in the US, still going a bit higher, but then coming down quite quickly over the course of that first quarter of 2024. Not dissimilar in Europe, although staying a bit higher for a bit longer. Unfortunately, in the UK, they are going to stay highest for longest, which is unfortunate. And while savers may like the fact that they can now get 5% if they invest through money market or cash funds on platform, that is obviously only probably going to be for the shorter term and at the cost of the economy and those who hold mortgages. So we're still looking at similar economic variables with the labor market and various wild cards. We would say the UK is currently lagging. We have little reason to believe that the UK is going to be crashing, particularly because the interest rate rises are somewhat self-regulating, and that once that cost of mortgage crisis hits the consumer, the demand will fall, which is exactly what the Bank of England unfortunately intends. And that fall in demand will very quickly quell any further upside in inflation. So when that happens, interest rates should also come down rapidly again, which then takes that pressure off the UK economy, which is still very, very much embedded in the global economic dynamics. So the outlook for 2023 and the economic variables there, we will have to see whether we can engineer that soft landing, which requires quite a lot of ifs, even though at the moment those ifs are on a good path. But it is something where the jury is at the moment out. The markets are finally balanced, going one way or the other. And for that reason, in your portfolios that you have with Tatton, we have for the time being remained neutral between equities and bonds, i.e. we're not necessarily foreseeing particularly much upside, but also not particularly much downside. And therefore, we're keeping it in balance while we have secured the higher yields that were available at times for portfolios, because I now no longer have to talk about bonds having run out of road. No, indeed, they are now something that we can play with and work with in the portfolios again, and over and underweight the different sectors. Regionally, we've also done some rating changes and had a now 8-month overweight to Japan, which has been a positive contributor to portfolio returns compared to our peers and compared to your own internal benchmarks. But we do have to caution that while we are still in this late cycle environment and the jury is out whether the central banks can both bring inflation under control while not throwing the economy into recession, that jury is still out. And while that is there, we will probably continue to see a continuation of those sharp sell-offs and then recovery surges as we've seen over the last 10 months. Now, that is the end of my talk. I'm very happy to take questions afterwards, but now I'm handing back to Sylvan.
Okay, thanks, Lothar. That was really good. Thank you for the insights. Now we're going to go over to Ben Palmer, who's lead portfolio manager at LGT Wealth Sustainable Investment Service. So he's going to talk to us about ethical investments and how they're faring at the moment. And I think just an indication time-wise, Ben will probably finish at around 2 o'clock. So yeah, over to you, Ben.
Apologies for struggling still after 3 years to find my unmute button. But thank you very much for having me along today to discuss sustainable investment. Lothar has very helpfully sort of framed the macro backdrop that we've been living in over the last couple of years. So I won't be delving into that too much, but I'll try and position it in the context of sustainable investing in portfolios and management. Very briefly at the top there, just for those on the call who aren't that familiar with sustainable investing and our proposition here at LGT, I'll quickly just frame what we do. So we tend to think about things in terms of a spectrum of capital. At one end, you have traditional investing where ESG and sustainable considerations don't play any meaningful part in an investment process or portfolio construction. At the other end of the spectrum, you have philanthropy, where you are essentially allocating capital to causes based on a non-financial return that's aligned to a sort of values or principles-based approach. But I'd say, importantly, for an investment context, there is no requirement on financial return. In the middle is where we build these portfolios. Now, there's a lot of uncertainty around the terminology used here, and there is some regulation that's coming through the pipeline, which will help consumers start to position how different propositions and approaches to sustainable investment sit and how they sit alongside each other. But for now, we think about things in these three areas. So responsible investment, this is ethical investing 101, if you like, the idea of putting formalized exclusions, so taking out certain product areas or behaviors from portfolios. We integrate several formal exclusions over certain products, including the usual ones, if you like, so tobacco, almonds, gambling, etc. Then we like to think about things in terms of broad sustainability. So we want to be identifying companies across the broader economy that aren't in the product areas which we find incompatible with our sustainable framework, that are exhibiting best behaviors with regards to how they manage their operational footprint, so how their business itself is impacting environment and society, but also, and this leads on to the third element, how their products are impacting the environment and society. So we look at things in terms of the sustainability of a business model, and also what it is that those businesses are doing in terms of what they sell, how they make money. So impact on the right-hand side is that's last piece of the puzzle. What products and services are we exposed to? And do we think that they're deriving or they're generating a positive, negative, or neutral impact on the environment and society? So a relatively broad approach to sustainability that spans across those three different mindsets. We do utilize a thematic framework. Some of you on the call may have seen this infographic before. It's become very popular over recent years as a way of creating a framework or a way of thinking about sustainability. They're the United Nations Sustainable Development Goals. As the name suggests, they were generated via the UN, and they provide 17 high-level aspirational targets primarily for policymakers to set their agendas pointing towards between 2015, when they were launched, and 2030. I'm not going to go through them all in any detail today, but for us, we thought this was a useful starting point to start translating that large, high-level aspirational targets, things like no poverty, zero hunger, as you know, SDGs 1 and 2, into a more focused, condensed investment framework of where can we allocate clients' money to that we think where public markets and companies can have a meaningful contribution. So we distill those 17 targets into our 4 investment pillars, which are indicated here. Broadly speaking, they can be split into 2 environmental areas and 2 societally focused areas. As I say, for us, we think they're the useful jumping ground from that high-level aspirational policy-making framework into an investment context. When we're doing our analysis of how investments might fit into that framework, then we use this 3 I's framework of intentionality, integration, and impact. This operates at 2 levels. Firstly, when we're looking at fund managers that populate our portfolios, and then also at the underlying company exposures that we hold within those funds. So intentionality is around, is this a core part of either a company's or a fund manager's process and their strategy? Do they exhibit sustainable characteristics just by happenstance, because that's just the way it lands on the time that you're analyzing them? Or is this actually purposeful and integrated and intentional in the business or in the fund manager? Integration is then making that assessment. Does that feed through the whole organization or fund process and outputs as well? So from a fund perspective, the underlying holdings, can that be exhibited throughout? And then impact is coming back to this idea of making an assessment of the products and services that we are ultimately exposed to through the companies that we invest in for our clients. Do we think that on aggregate, they are providing a positive contribution to one or more of our 4 pillars, a negative contribution, or in some instances, broadly speaking, a neutral impact as well? Before I move on to kind of the more up-to-date market and contextualizing piece, I just wanted to touch on the resource that we have at LGT with regarding to sustainable investing. I'm a relatively new joiner to the business, coming from one of our peers, and this was one of the reasons that brought me across, is this commitment to sustainability that's really feeding through into the level of resource that the company has grown over recent years. Some of you may have heard of or spoken with at similar events, Phoebe Stone, who's up there in the top left. She approached me about the role and joining her expanding team at LGT. But on the investment side, we have, this is just indicating some of the key managers, but there's 4 of us who are very much integral and central to the running of sustainable money within LGT. On the on the research side, the one name I'll highlight is Matt Wiles, who's our full-time sustainable fund analyst. He leverages off the wider research team for their individual asset class capabilities, but having that full-time resource where he is day-to-day looking at our existing investments in the space, but also sourcing new ideas is extremely helpful. 2 areas which I do think differentiate us are our use of data. We don't think data is the answer to sustainability, but we do think it gives you a very helpful and increasingly informative viewpoint on the characteristics of underlying companies. And we have 2 full-time analysts now that not only look after our proprietary data tools, but are continuing to develop and evolve them as the data sets improve. And then finally, stewardship. The company hired a lady called Siobhan Archer 2 years ago from the UN, and she has put some significant frameworks around how do we, in the context of MPS management, how do we talk to engage with our fund managers on a much more structural basis and really hold their feet to the fire in terms of ongoing assessments of whether what they're doing is fully aligned to what our sustainable objectives are, indicated by those 4 pillars. So moving on now to the market context of sustainable investing and really leveraging off a lot of what Lothar has mentioned in his presentation, but I'm just going to sort of condense it down to one of the key market narratives over the last 18 months, this idea of growth and value investing. What we saw last year in a rising inflation and therefore rising interest rate environment are companies that are largely valued off what they're going to do in the future. So growth companies, where you are paying for future, as the name suggests, growth in terms of their revenues and market share, sold off quite significantly. Largely speaking, it is a mechanism of how you value those companies where interest rates is a really important integral part. And essentially as interest rates go up, how you value revenues in 3, 5, 10 years time, they become less valuable to you today. So we saw a sharp sell-off in a lot of growth parts of the market. Value, which we've got some examples of the types of sectors that indicates where you are actually paying more for what the company's doing today. How much do we think the revenues that this company is making today should be valued? You're not putting a huge emphasis on how are they going to grow those over time. Held up a lot better in that environment. So over the course of 2022, value sectors outperformed growth sectors by over 20%. And this was obviously extremely meaningful and did create some headwinds for sustainable portfolios and us included, because sustainable investment tends to lead towards a overweight to growth sectors, such as technology being the primary area, and an underweight to traditional value areas. I've highlighted some there, but things like traditional energy is a key component of a value basket, oil, gas, things that we're not likely to have any exposure to, or certainly very minimal in terms of any sort of tangential exposure. Other areas of value investing, things like materials, financials, utilities, again, they tend to be structurally underweight positions within our portfolios because of the sustainability objectives. And we do have a meaningful exposure to technology, which was the worst performing sector through the course of last year. Should be noted, this was following an extremely strong period of 1 to 2 years in that post-COVID era, but certainly last year, the tides changed and it created some performance challenges for us as a service. This year, actually, we've seen a kind of flip reversal yet again, where growth has outperformed year-to-date value by about 20%. But interestingly, when you dig under the bonnet of what's driven that growth resurgence through the last few months, it has been predominantly driven by a very small basket of US technology firms, which are indicated here, 7 names to be quite precise about it. And this is really based on I would frame it potentially as an exuberance around the potential of AI that I'm sure you've been reading about in the press over recent months. And any firm that has a strong hold in developing AI solutions has benefited from that, and share prices have exponentially grown in some cases. So actually, if you split those 7 names out from the broader US market, then the headline return of the S&P 500 will say around 10% year to date. If you strip those 7 names out, it's actually broadly flat / up about 1%. So this is one of those examples where you really need to dig under the bonnet of some of those headline numbers to understand what is driving markets, what is moving markets. But certainly year to date, it's fair to say that growth has regained some of those losses we saw last year, predominantly because of this narrative, but broadly speaking, we have seen some support across that space as well. Apologies, this is a very busy slide here, but what I wanted to do is just frame that market context in terms of our portfolios and read across to broader sustainability mandates, but obviously I'll talk mainly about what we've been doing. As I said, we do tend to have some inherent biases and overweights to certain parts of the market that tend to lead us more down the growth avenue than the value. We see huge opportunity within the technology space and the industries linked to that to drive innovation and change in our economy, which will ultimately lead to a more efficient economy, helping in things like the transition to a low carbon economy, and also efficiencies in terms of how we work and how we can open up society as well. However, we did make some relatively meaningful changes to portfolios in the first half of last year, just to dampen down some of those growth characteristics and increase our value exposure. Importantly, not to the areas which I highlighted on the previous slide. We're not now trying to reimagine sustainability of our objectives and start buying our oil companies. We identified 2 fund managers, which we believe give us the exposure we want from a characteristic value exposure perspective, but actually fish in other ponds rather than those more traditional areas which we find quite challenging. So things like telecommunications, pockets of financials as 2 examples, or consumer discretionary. So you'll see on the top left, our value exposure in our equities has gone from about 5% to 15%. And the second line up there is our growth exposure has gone from about 45 to 35. So I would frame us as a relatively diversified core solution for a sustainable investor. The bottom left chart shows our sector allocations, and you'll see as you read down the list there that information technology is still our largest exposure, but it's around 30%. So not huge. It's a slight overweight compared to the global index of about 7 or 8%, but I wouldn't want investors to think that we are a technology solution with a few bells and whistles around the edges. We are diversified across the economy. We're wanting to avoid the areas that we don't think are compatible with driving change, but also we are looking for good actors in the other little pockets that we can find. On the right-hand side, just want to give you a viewpoint in terms of some other important characteristics. Firstly, the top right one is looking at valuation, and Lothar had some good slides on market valuations. And where the red line is to the left-hand side, the green line, I should say, is our medium risk portfolio, our balanced portfolio, and the blue line is the wider market. We did trade at a significant valuation premium to the wider market at the end of 2021 because of the share price, the positive share price movements in a lot of our technology names and growth parts of the portfolio, which had driven really strong relative and absolute performance returns for clients. Through the changes we've made in portfolios and the movements in markets, as we stand today, although we still trade at a slightly more expensive level to the wider market, it has been much reduced. So I would say that we are comfortable paying a bit more for the companies we own because we want to buy growth, we want to buy quality, which we think are 2 important characteristics. But ultimately, we're not overpaying in this current environment, in our opinion, if we can take a longer term view. And the last snapshot is there in the bottom right is going back again to one of Lothar's points about indebtedness and the fact we're going through this refinancing cycle. The green line again is our portfolio, the blue line is the market, and this is showing you debt to capital ratios, which is a simplistic way of looking at how much debt does a company own. And importantly for us in the current environment is en masse, our companies hold less debt that they're going to have to refinance over the coming years, again, which we think is quite important. Aware that kind of very quickly running out of time, but I just wanted to touch on 1 or 2 final points, if I may. Firstly, obviously, performance. Longer term performance is very strong on an absolute and a relative basis. We had some very strong years in 2020, 2021. Last year was challenging, which I'll dissect a little bit more in a moment. But more recently, actually, performance on a relative basis has been strong against those ARC benchmarks, as we've seen a little bit of a emergence of growth, but also in a lot of instances, a refocusing on some of the sustainability benefits of our portfolio following things like the Inflation Reduction Act being announced in the US, and an equivalent measure of packages in the EU as well, which we think support and provide long-term tailwinds for a lot of the companies we're exposed to. Looking at this is monthly performance of our balanced portfolio versus the ARC benchmark, which is the black line, and then the IA sector, which is another broad comparator of equivalent risk profiled funds in the market. This is a monthly return, so very short term, these bars. But as I said, 2022 was a challenging year for performance, and appreciate some of you on the call might have been exposed to that. And I sometimes get asked, well, when will sustainability turn around? When will it become an attractive investment proposition again? And my answer to that is that when you look at 2022, we felt the real pain in a single month, which was January, which is highlighted there, where the portfolio really did significantly underperform, because that's when we saw the sharpest rotation out of a lot of those growth areas which we were exposed to. If you roll on through the rest of the year and certainly into this year, then against a very challenging backdrop, so I would say, negative markets, broadly speaking, on a relative basis. So how did these portfolios compare to our core portfolios or the wider, non-sustainable investment market? It was much more comparable. We had months of outperformance and underperformance. So I would say that sustainability as an investment proposition isn't broken. We had a particular period of underperformance, which was felt for the rest of the year in terms of looking at the numbers. But actually, a lot of our names are beginning to perform quite well. Unfortunately, because of time, I can't really come on to the opportunities in too much depth. But I'll just sort of surmise very briefly that we do still see a lot of long-term structural support for the 4 pillars that we invest within. I've already mentioned the Inflation Reduction Act in the US, which will provide nearly $400 billion worth of tax credits in the US for transitioning their economy to a low carbon future. We're exposed to a lot of names which will be the enablers and the beneficiaries of that. Another area which we don't talk about a lot in the industry, because we all focus on climate, but if we're looking at a social area in our portfolios, is global healthcare ecosystems. We're coming out the back end of a pandemic, and we're only seeing global healthcare spend go in one direction. And we think this, coupled with the demographic shifts that we're going to see play out over the next 1 to 2 decades, where we're seeing an aging population around the world, is going to provide a lot of impetus and tailwinds for companies which are improving the resiliency and the delivery of healthcare, because ultimately we're going to have less people paying for it, less people in the working age section of society, and a lot more old people who are going to require a lot more healthcare, chronic healthcare provision as we lead through. So again, just very quick whistle-stop tour, but for us, we think that there are many other examples of those 2 big macro megatrends, which we can try and find companies that can fit in the slipstreams of and be beneficiaries over the longer term. And the last thing I'd say is we won't provide, or we won't say, and I don't envisage us providing outperformance over every quarter, over every calendar year, but we do think that these structural long-term megatrends will provide more tailwinds to performance than headwinds over the longer term. So with that, apologies for overrunning slightly, but I'll hand back.
No, that was great. Thank you, Ben. Yeah, very helpful and really interesting as well. So thank you to both of the speakers. I hope that's been helpful for everyone who's joined us today. We still have a few minutes to answer a couple of questions that people have emailed in advance of today's webinar. One question I think Ben covered very well. So it was, do you have a preference for the growth or income investment style in this current climate? So income. I think Ben explained very well that growth strategies, tends to be smaller companies or those that aren't paying a high level of dividend, whereas income, on the other hand, would be an investment style that incorporates a lot of companies that tend to pay a high level of dividend. We don't place big bets on either outcome, or one particular style. All the investment solutions that we use have a blended approach or a barbell approach, as Ben explained, because we want our client assets to be safe ultimately, and to be positioned for the majority of economic outcomes. So we do keep that under review as a part of our due diligence process. So we have had another question. So that reads: are there any instances in which in which you would not use discretionary investment solutions? So do you want to take that one?
Yeah, I'll take that one. I think it comes back to the fact that fundamentally we are financial planners. That's what we're doing, and we will have circumstances where it's appropriate for us to use other solutions. So clients might come to us with an existing product in place, and as long as we can achieve the outcomes for them, and that will be through measurable risk-adjusted returns on a sustainable basis at a reasonable cost. And we're not in the business of switching people for the sake of it, where we can use existing products to do that. So certainly we do have other solutions, and we do look to utilize other products as well, and clearly keep those under review as appropriate as well.
Okay, great. Well, that's about all we have time for today. So for those of you who emailed in, but we didn't get around to answering questions, we'll get back to you separately. And if anyone has any questions as a result of today's talks, please do email in. And so that's it from Ed and I. So thank you for joining us, and have a great afternoon.
Thank you very much.
Thanks.
Bye-bye.
Bye.